Good morning. I'm joined by Lucy Macdonald, CIO at Allianz Global Investors, who's going to talk to us about Brunner Investment Trust. Lucy, welcome.
Morning.
First of all, can you tell us what the sort of threats and opportunities are in an environment of rising volatility?
Well, if we start with the threats, the volatility we're seeing at the moment seems to be coming through mostly in the currency markets. And the threat for markets more generally is if that really begins to have more of a feedback into the real economy and pulls back confidence from the companies themselves from investing. So far, we haven't seen that, but it is creating more distortion around corporate earnings. So that's a threat. On the opportunity side, as an investor, it can give you great opportunities for buying into confusion in markets. And we have done that in the trust in some of our stocks, Adidas, for instance.
Interesting. And do you, broadly speaking, invest in the United Kingdom for income and abroad for growth? Yes,
the UK is still a very high-yielding market. So it's yielding more like 3.5%, whereas the global markets are more like 2.5%. And so it does make sense to be using the UK for yield. However, we are looking further afield for yield now into Europe and Asia. But also there are some areas of latent dividend potential which we think are very interesting. One of those being Japan, where we are now seeing some move to increase the payout ratios. Also in technology, where it's not been an area of big dividend paying in the past, but we are now seeing Microsoft, for instance, beginning to pay more of a dividend. That is also interesting. But the third area is financials. And that's an area where regulations that's been holding people back, companies back, from paying dividends. And that is now, we are now beginning to see those regulations allowing dividends to be paid again. So UBS, for instance, a stock that we own, is now beginning to pay more of a dividend. But also in the US, in Wells Fargo and Citigroup we own too. We're both seeing that.
And on that same theme, what things about a company particularly attract you?
Well, we like companies which have got the ability to grow. And we are in an environment where growth is scarce. So any company that can grow its top line through overseas expansion, through products, services, innovation is attractive to us. But we also like good quality growth. So we like companies which have got wide moats, big margins, strong market positions, and well managed and well financed. So all of that is interesting to us. But we like all of those attractive features not to be completely recognised by everyone else in the market. And so valuation is also important. But it really is that way around. We don't believe that you can value anything when you don't know what it is. So looking for growth, looking for quality, and then valuing it is the way that we do it.
And what are the big changes that have taken place if any, in the portfolio over the last year?
Well, we don't tend to do big radical changes in the portfolio. If things are working, it should be relatively smooth. Turnover should be relatively low, around 20%. But we have been consolidating the portfolio over the last few years. And so, bringing it to make sure that it is active enough and that we have enough potential for outperformance. So we are now down to around 80 names. And that's, I think, where we'll probably will stay.
I see. And how do you balance an actively managed portfolio with relatively low turnover?
Well, there is confusion about what active management means. And active to us is meaning you're different from the index and that you have sufficient differences to allow you to outperform the index. What it doesn't mean is churning the portfolio over. And the only beneficiaries of that are stockbrokers rather than the underlying investors. So for us, the active is really meaning that you're very different from the index, and we have got an active share overall, which is in the high 70s. It would be higher, but there are some large index stocks in the UK part which are there specifically for yield.
What's the longest held Brunner stock, and how does it exemplify the broader aims of the trust?
Well, one that's been in the longest is Apple. And I started managing the overseas part of the portfolio in 2005, and it was one of the first stocks that we put in there. And it really has the growth potential we've talked about. That's been there and it's come through over a number of years through the iPod, through the iPhone and the iPad, and now the iWatch. So there's been innovation at the top line and there's been overseas expansion and all of those things that we've talked about But it's also been high quality growth and well-financed growth. It's a very strong balance sheet. And it still is not a particularly expensive share. So when you look at it relative both to technology but to other stocks around the world, despite the fact that it has gone up 4 times since we bought it, the underlying business has been growing, and so it really hasn't had an enormous revaluation. And that to us is still interesting.
And on a completely different note, what do the new rules around pensions mean for investors?
Well, it's a very interesting time, and we think that the investors who are freed from the constraint of having to buy an annuity will still want some certainty, but they will be very interested in low cost, transparent, and outcome generated product. And that, we think, will mean that they're more interested in income and looking for income elsewhere. And that means we think they will be led towards equities because you can't really find income anywhere else. And so I think it will lead people to look back at equities, which have been thought of and still are sometimes as quite volatile, quite risky. Well, it's true. There is risk of capital loss, but at the same time, there is the potential for quite healthy income and growing income. So for a portion of portfolios, depending on the individual, it does make sense to have your equities in there.
And what do you think the biggest risks for equities over the rest of this year are?
Well, the biggest risk is absolute valuation risk, and that is based on the very low interest rates at the moment. And that is what is really supporting the level of the market. So any uncertainty around long bond yields in the US is likely to cause some more volatility as we go through the year. And that we need to be quite careful about. There are obviously geopolitical issues around which could affect. There's Russia, there's Brazil, there's China, and the Chinese slowdown could have more of an impact. So there's plenty of geopolitics around. But I think when it comes down to it, the real thing that you worry about with equities, we said, is capital loss. And so you have to look at the absolute valuation, and that is very much driven by low interest rates at the moment.
And finally, is there anything else that a potential investor in Brunner should look out for over the next few months?
Well, I think the UK election is something that will probably be very much on people's minds. How much that really is going to affect markets, I think, is less clear. Generally, there will tend to be focus on the currency, and there will be focus on potential for exit from Europe. Those things are important. But as far as the underlying companies that we invest in are concerned, there really are companies which should be able to ride through whatever comes out of it.
Thank you very much. And if you'd like any more information, please visit either the Brunner or the Edison websites.